Hello everyone, here our group would like to present on financial ratios of our chosen company, Panasonic Manufacturing Malaysia Berhad. But before we move further, let me introduce you our group members that will present their part respectively. My name is Nik Muhammad Aizat bin Fakri and I'm the first presenter. The second presenter is Nur Natasha Akila binti Alias. The third presenter is Zahira Elisha binti Zulkifli. The fourth presenter is Nur Zarif Sofia binti Razali, and the last presenter is Nur Anis Amira binti Madrozi. But first, let me introduce you to the Panasonic Manufacturing Malaysia Berhad. Panasonic Manufacturing Malaysia Berhad is a public listed company listed on main market of Bursa Malaysia Securities Berhad. Panasonic engaged in marketing and distribution of various consumer products, manufacturing and sale of electrical home appliances and related components. Panasonic have various products such as ceiling and table fans, camera, rice cookers, home shower and other products. Surprisingly, in 2018, Panasonic has achieved its third times of sale cross 1 billion mark, which is RM 1.199 billion, which increased about 76 million as compared to 2017. Furthermore, in 2018, Panasonic has won the Panasonic Corporation Award, Home Appliance Division and Brand Management Award for Best Performing Overseas Corporation. Okay, now let's move to the presentation of financial ratios and its analysis on the ratios respectively. Stay tuned, guys. Now we will explain on 4 financial ratios. The first one is liquidity ratio, the second one is efficiency ratio, the third is the leverage ratio, and the last is the profitability ratio.
Is to measure a company's ability to convert its asset to cash in order to pay its liability when they are due. Analysis of the liquidity ratio refers to use of multiple ratio to determine an organization's ability to pay its bills promptly. This analysis is particularly important for lenders and creditors who want to get some idea of a borrower or customer financial situation before giving them credit. Okay, there are several ratios under this liquidity ratio available, which is current ratio, quick ratio, and cash ratio. All these three using the same definition of liquid asset being compared to short-term liabilities. Okay, so here's a table shows a calculation of those three ratio under liquidity ratio of Panasonic Manufacturing Malaysia Berhad in 2017 and 2018. Okay, so the first ratio under this liquidity ratio is a current ratio. What is current ratio? Current ratio is to measure how far the claims of short-term creditors are covered by current assets. Current ratio for Panasonic Manufacturing Malaysia Berhad from the table shows that in 2018 is higher 21 cents than 2017. For 2018, the company has 4 ringgit and 41 cents in current asset for every 1 ringgit in current liability. Meanwhile, in 2017, it shows that the company has 4 ringgit 20 cents in current asset for every 1 ringgit in current liability. Panasonic Manufacturing Malaysia Berhad is more liquid in terms in current asset in 2018, better than 2017 to pay off its liabilities. So from the table shows the current ratio increase in year 2018 is because the annual report shows a rising of shareholder funds. Okay, second ratio of liquidity ratio is a quick ratio. quick ratio is to measure the firm's ability to pay off its short-term obligation without having to rely on the sale of inventory and prepaid. The quick ratio for the year 2018 are higher than the 2017, whereby the quick ratio for the Panasonic Manufacturing Malaysia Berhad in years 2018 is 4.14 times compared to year 2017, which is only 3.92 times. Panasonic can meet their current liability with the available quick funds on hand in 2018 than the previous year, which is in 2017. From this comparison, we can conclude that Panasonic able to pay its current liability in a timely manner, and at the same time, Panasonic able to increase their sales so that the cash and account receivable increase. Lastly, the ratio for the liquidity ratio is the cash ratio. Liquidity metric that indicates a company's capacity to pay off short-term debt obligation with its cash and cash equivalents. Cash ratio is to measure the ability of the firm to use its cash and cash to cover all the company current liability without having to sell or liquidate their assets. The cash ratio for the Panasonic for the year 2017 is 3.28 times, whereas in 2018, the cash ratio is 3.44 times. So we suggest that Panasonic should set aside some cash in hand so that they can pay its current liability in the required times.
I will proceed with debt ratio, which it will measure the debt level of a business as a percentage of its total asset. So to calculate the debt ratio, it requires total debt divided with total asset. The debt ratio total of 2017 of Panasonic company is amount to 18%. For 2018, its amount to 17%. So it means that the Panasonic has improved as the total of debt ratio in 2018 is lower than 2017. A very low debt ratio is good for the company in the sense that the company assets are sufficient to meet its obligation. A very high debt ratio indicates high risk for both debt holder and equity investors. If the company faces the high risk debt ratio, the company may not be able to obtain finance returns or may not be able to raise any more money at all. For the debt to equity ratio, it shows the percentage of company financing that comes from creditor and investor. So how to calculate the debt to equity ratio, it requires total debt divided with total equity. So for Panasonic company, for 2017, their debt to equity ratio is 22%. For 2018, it's 21%. The debt to equity ratio of Panasonic company is in control as the total is decreasing from 22% to 21%. So the lower of debt to equity ratio of a company implies more financially stable business. If the company with high debt to equity, it considered more risky to investor and creditor. So that means the Panasonic company is performing well in terms of their earnings because their debt to equity ratio is decreasing. For time interest earn ratio, it's sometimes called interest coverage ratio. That measures the proportionate amount of income that can be used to cover interest expenses in the future of the company. So to get time interest earn ratio, it requires income before tax and interest of the company divided into interest expenses. So for 2017, the Panasonic company time interest earn ratio amount to 5.6 times, and for 2018, it's total to 7.3 times. So Panasonic company's ratio has increased from 5.6 on 2017 to 7.3 on 2018. This means that company makes enough income to pay for the total interest expenses from 5 to 7 times over. This company's income is 7 times higher than its interest expenses for the year.
Okay, next is efficiency ratio. So efficiency ratio, also known as the activity ratio, measure how well the companies utilize their asset to generate income. It usually looks at the time it takes for the company to collect cash from customer or the time for the company to convert the inventory in cash. Usually used by the management to help the company to improve as well as outside investors and creditors looking at the operation of the profitability of the company. Efficiency ratio is the one who go along with profitability ratio. Most often, when the companies are efficient with their resources, they will become profitable. First is inventory turnover. Inventory turnover ratio is the number of times a business sells and replaces their stock of goods during the given period. A high inventory turnover generally means that goods are sold faster, and a low turnover rate indicate the weak sales. So inventory turnover is COGS divided by inventory, which is mean the inventory turnover for the year 2018 is 19.01, higher than 2017, which is 17.88. That is mean the company may increase it of the demand for inventory. Second is the average collection period, ACP. The average collection period of account receivable is the average number of days it takes to convert receivable into cash. It also marks the average number of days it takes customer to pay their credit account. So a short collection period means prompt collection and better management of receivable. A longer collection period may negatively affect a short-term paying ability of the business in the eye of analysts. Whether a collection period is good or bad depends on the credit term allowed by the company. So how to calculate the ACP is account receivable divided by sales and multiply by 365 days. So for the year 2017, Panasonic has the average collection period by 37.98 days, while for the year 2018, the average collection period is 38.24 days. The collection period for the year 2018 is increased by 38.24 days, where it affects the short-term paying ability. Okay, the third is total asset turnover. Total asset turnover is a financial ratio that measures the efficiency of a company use of its asset to product sale. The ratio helps to measure the productivity of a company's asset. And how to calculate the total asset turnover is sales divided by total asset. Asset turnover ratio of the Panasonic is 1.12. It means every ringgit invested in the asset of Panasonic produce 1.12 of $1.12 of sales for the both years remain the same. Basically, the higher the number is better. If there is a low turnover, it may be an indication that the business should either utilize its asset in a more efficient manner or just sell them. For the four ratio is receivable turnover. The receivable turnover ratio indicates that the velocity of companies that collection the number of time average receivable are turned over during a year. This ratio determines how quickly a company collects outstanding cash balance from its customer during an accounting period. It is an important indicator of a company financial and operational performance and can be used to determine if a company is having difficulties collecting sales made on credit. How to calculate the receivable turnover is the sales credit divided by account receivable. If the credit sale is not available, then it can use the revenue. Okay, The receivable turnover in Panasonic for year 2017 is 9.61, means that they are more efficient in collecting their account receivable compared to 2018, which is 9.54, that less receivable turnover. So from this, Panasonic can improve their receivable turnover by provide incentive for early payment, such as offer discount or reward for early payment of invoice. The last is fixed asset turnover. Fixed asset turnover ratio compares the sales revenue a company to its fixed asset. This ratio tells us how effectively and efficiently a company is using its fixed asset to generate income. It indicates the productivity of fixed asset in generating revenue. If a company has a high fixed asset turnover ratio, it shows that the company is efficient at managing its fixed asset. Fixed assets are important because they usually represent the largest component of total asset. How to calculate the fixed asset turnover is sales divided by fixed asset. So in 2017, Panasonic has more efficient in fixed asset turnover, which is 14.98 times compared to 2018, which is 12.34 times. So how to improve this is they might sell the fixed asset that they did not use, which did not improve the bottom line on the regular basis. Also, they can list the equipment to make for the sold asset, because leased equipment does not count as the fixed asset.
Okay, so now we move to the profitability ratio. Profitability ratio is a financial metric used by analysts and investors to measure and evaluate the ability of a company, which is in our case study Panasonic, to generate income, which is profit relative to revenue. The ratio itself shows how well Panasonic utilizes its asset to produce profit and value to shareholder. The ratio are most useful when they are analyzed in comparison to similar company or compared to the previous period. So there are 5 items, the key item that is measured in the profitability in order to know the profitability ratio. The first one is gross profit margin, the second one is operating profit margin, the third one is net profit margin, fourth is return on asset, and the return of equity. So we move to the gross profit margin. So what is gross profit margin? Gross profit margin is metric used to assess a company financial health and business model by revealing the amount of money left over from sale after deducting the cost of goods sold. The gross profit margin is often expressed as a percentage of sale and may be called the gross margin ratio. So based on the calculation above that that we have made, it shows that for every 24.89 cents in Panasonic sale, in profit they spend almost 75.11 cents to make the operation cost. Meanwhile, in 2018, for each 25.36 cents, they spend 74.64 cents for the operation cost. So the higher the gross profit margin, the more stable Panasonic is considered. Meanwhile, a higher profit margin indicates that the Panasonic is making more sale of the company itself. Based on the calculation of the ratio above, it shows that the gross profit for the year 2018 increased by 0.47% from 24.89 cents in year 2017 to 25.36% for the year 2018. So, based on the gross profit margin in 2018, it shows that a higher efficiency of core operation of Panasonic
which means that it can cover the amount of operating expenses, fixed costs, dividend and depreciations, while also providing net earning to the business. In addition, for the year 2017, the gross margin ratio is lower than 2018, probably because high cost of goods sold, which can adverse purchasing policies, low selling prices, low sale, stiff market competitions, or wrong sale promotion made by Panasonic company. So now we move to the second ratio, which is operating profit margin. Operating profit margin is to measure the overall proficiency incorporating all the expenses of the ordinary and daily business activities. The operating margin ratios, also known as the profitability ratio, that measure the percentage of the total revenue is made up by the operating income. In other words, the operating margin ratio demonstrates how much revenue are left over all the variable or operating costs have been paid. So, the continue is the operating market ratio is a key indicator for the investor and creditor to see how businesses are supported their operation. If Panasonic can make enough money from their operation to support their business, the company is considered more stable. In fact, if Panasonic require both operating and non-operating expenses to cover the operation expenses, it shows that the Panasonic itself, the business of Panasonic itself, are not sustainable. So based on the calculation that we have been made, the operating profit margin for the year 2017 is higher compared to 2018 ratios. This means that in 2017, Panasonic have higher operating margin, which lead to have more favorable compared to 2018, as they have only 17.53% compared to 2017, which is 17 and 66%. This ratio shows that in 2017, Panasonic is making enough money from its ongoing operations to pay for its variable costs as well as its fixed assets. For instance, every 1 ringgit of income of Panasonic, only 17.53 cents remain after the operating expenses have been deducted, while in 2017, only 17 and 66 cents remain. This also means that only 17.53 cents and 17.66 cents both remain is left to cover the non-operating expenses. So now we move to the net profit margin. Net profit margin is a percentage of revenue left after all the expenses have been deducted from the sale. The measurement reveals that the amount of profit that Panasonic can extract from its total assets. For instance, net profit is excess 10% is considered excellent, which can be seen from both years of Panasonic net profit margin have exceed more than 10%. In 2017, the net profit margin is 14.14%, which is higher than in 2018, which only 13.70%. In 2017, based on the ratios, it means that Panasonic pricing its product correctly and it's exercising good cost control. For every 14.40 cents of every 1 ringgit is a profit for Panasonic itself. Meanwhile, in 2018, for every 13 and 17 cents of every 1 ringgit is a profit of in that certain years. So we move to the return on asset. Return on asset ratio is often called the return of total asset. Is a profitability ratio that measures the net income produced by total asset during a period by comparing net income to the average total assets. This ratio helps both management and investors to see how well the company can convert its investment in asset into profit. By comparing the return of asset in 2017 and 2018, The return of asset in 2017 is more efficient because Panasonic can convert the money used to purchase asset into net income profit compared to 2018. So this means that the higher ratio is more favorable to investor because it shows that the company is more effective in managing their asset to produce greater amount of net income, which can conclude that their investment in 2017 is more great than 2018, as in 2017 their ratio is 12.64%, while in 2018 their ratio is 12.23%. So in 2018, every 12 cent whole asset for each 1 ringgit, while in 2017, for 13 cents of RN 1 ringgit, the lower the profit per RM of the asset, the more asset incentive of Panasonic is considered to be. Highly asset incentive require big investment to purchase machinery and equipment in order to generate income. So now we move to the return on equity. The return of equity measure the return on money to the investor have put into the company. This ratio is important for the investor to look when deciding whether or not to invest in the Panasonic itself. So based on the return of equity, it can be concluded that Panasonic, the return of equity is decreased from year 2017 to 2018. The investors want to see a high return on equity ratio in order to indicate that Petronas using its investors fund effectively. So the return on equity in 2017, which is 15.47, is higher than 2018, which is only 14.86%, lower than the ratio in 2017. Many investors also choose to calculate the return on equity at the beginning of the period to see the change in return. This will help Panasonic progress and improve the ability of Panasonic to maintain a positive earning trend.
So guys, we have come to an end of presentation. So here, we would like to recommend to the Panasonic to improve its promotional activities and maintain their activities.